The fortification has fallen. For months, the entirety of the financial establishment proclaimed that $65 represented an insurmountable barrier. They declared it an uncrossable frontier. They asserted that financial institutions would defend it with every derivative contract in their possession. However, today, Wednesday, the 17th of December, the collective market voiced its verdict, and it opted for aggressive upward momentum. We not only reached $65, we shattered it. Earlier today, the valuation of silver surged dramatically, reaching $66.50. As I address you now, we have experienced a slight retreat to $65.80. 80 cents. Now, I understand your present sentiments. You are observing this pullback. You are witnessing the price decline from its zenith of $66.50 down to $65.80. An apprehension begins to permeate. You are posing the question to yourself, was that it? Was that the peak? Is this another deceptive move? I implore you to pause and listen with utmost concentration. What we are currently observing is not a collapse. It is not a failure. It is the most crucial indicative behavior a market can demonstrate. It is termed a retest. In this in-depth market analysis, we will dissect the mechanics of this price surge. We will elucidate precisely why the price ascended so rapidly to $66.50. We will deconstruct the mechanism of the gamma squeeze that compelled financial institutions to acquire assets against their volition. And most significantly, I will demonstrate why this retreat to $65.80 is, in fact, a beneficial development. Had we continued our ascent without interruption, we would have experienced a sharp decline. However, by pulling back and testing this established lower boundary, we are constructing the platform for the subsequent upward movement. The impediment at $65 has crumbled. Now, we must fortify the remnants. This is the narrative of the breakthrough. To comprehend the astonishing leap of silver from $64 to $66.50 this morning, one must grasp the underlying architecture of the market. One must comprehend gamma. Gamma is a concept utilized by options traders. It quantifies the rate of change in a market maker's exposure. Consider the market maker as the establishment in a gambling house. They are consistently taking the opposing side of bets. They had sold millions of ounces worth of call options at the $65 strike price. These options represent wagers that the price of silver will increase. As long as silver remained below $65, the establishment was profiting, as the options held no intrinsic value. However, the instant silver surpassed $65, the establishment began incurring losses, and not minor ones, but exponentially escalating losses. When the price touched $65.10, the market maker's computer systems signaled an emergency. To safeguard the institution from substantial financial damage, the system automatically initiated the purchase of silver futures contracts. They acquired these contracts not out of a preference for silver, but as a hedge against their existing positions. However, this created a predicament. Their purchasing activity drove the price higher to $65.30. This, in turn, amplified their risk exposure. Consequently, the system executed further purchases, propelling the price to $66. This phenomenon is known as a gamma squeeze. It represents a self-reinforcing cycle. It is the identical mechanism that propelled GameStop to $400 in the year 2021. It has no bearing on intrinsic value or the principles of supply and demand. It is purely a mathematical construct. This morning, that mathematical imperative overwhelmed the financial institutions. The sharp ascent to $66.50 was the audible manifestation of algorithms executing panicked buy orders to cover their liabilities. It was a demand-driven surge, devoid of sellers, populated only by automated systems, desperately attempting to acquire assets. So, why did the advance halt? Why did we recede to $65.80? Because human participants intervened. Traders observed the precipitous vertical price movement and decided to realize their profits. The aggressive buying fueled by gamma reached its saturation point, and now we are returning to a more grounded valuation. However, the impact has been made. The $65 threshold has been breached. The psychological barrier has been shattered, and the market makers are now apprehensive. They are aware that the edifice can falter. Let us examine the current valuation. $65.80. To the novice observer, a decline from $66.50 suggests weakness. To the seasoned professional, it signifies confirmation. There is a fundamental principle in technical analysis. Previous resistance levels subsequently transform into support levels. For months, $65 served as a ceiling. Each instance we approached it, the price retreated. It was an unyielding barrier. Today, we have penetrated that barrier. Now, we are positioned atop it. We are testing its stability. We are assessing its integrity. This retreat to $65.80 represents the market's validation of this new floor. We require buyers to step in at this juncture. We need to observe the price maintaining its position above $65. If we remain above $65 for the remainder of the trading session, it will validate the breakout as genuine. It will communicate to the global markets that $65 is no longer a price point for divestment, but rather a price point for acquisition. Nevertheless, I must issue a caution. This is the juncture where prudence is paramount. Should the price decline back below $65, should we conclude the day at $64, that scenario is termed a false breakout. It signifies the failure of the upward surge, indicating that sellers retain control. Typically, a false breakout precipitates a substantial market downturn. Therefore, $65.80 is a critical juncture, a battleground. We are presently within a transitional zone, possessing 80 cents of buffer above the precarious threshold. Do not prematurely celebrate. We must await the closing price of the day. We must ascertain whether the former ceiling can genuinely sustain the weight of the current valuation. Recall the significant entity we discussed, the enigmatic purchaser who acquired $650 million worth of silver at $63. Everyone inquired about their whereabouts. Did they divest at $66.50? Did they offload their holdings onto retail investors? I have been meticulously observing the order book throughout the morning, and I can definitively state this. That significant entity remains actively engaged. As the price receded from $66.50 to $65.80, substantial block orders materialized on the buy side. Someone stepped forward at $65.75, indicating a willingness to purchase. This provides critical insight. Informed capital perceives $65 as an advantageous price. Last week, they considered $63 to be advantageous. Now, they are prepared to offer more. They are actively defending this upward momentum. This is not indicative of speculative behavior aimed at liquidation. Speculators tend to sell into strength. This particular buyer is supporting weakness, establishing a floor beneath the market to prevent a reversion below $65. Why? Because they understand what lies ahead. They recognize that if $65 holds, the subsequent target is not $66, but rather $70, and subsequently $85. They are establishing a secure base, consolidating their position before embarking on the next phase of ascent. Consequently, when you observe $65.80 on your display, do not perceive it as a decrement. View it as a period of consolidation. Consider it an opportunity for major market participants to replenish their resources. The gamma squeeze served as the initial catalyst. The retest represents the fuel. However, the conflagration, the true inferno, is ignited by short sellers. Commercial financial institutions, such as JP Morgan and Bank of America, have maintained substantial short positions in silver for years. They have engaged in the sale of derivative contracts to artificially suppress the price. However, at $66.50, their potential losses have become catastrophic. In the subsequent segment, we will examine the capitulation of these financial institutions. We will explore the prevailing conjecture that a prominent commercial bank initiated the closure of its short position this morning. We will elucidate why the unwinding of short positions acts as a propellant for price appreciation. And we will precisely calculate the financial losses incurred by these institutions over the preceding 4 hours. The breakthrough has occurred. Now, the panicked covering of positions is commencing. Stay tuned for the second part. We will be tallying the financial repercussions for the banks. If you are just joining us, allow me to re-establish the context. We have confirmed the price breakout. Silver has surged past the $65 ceiling, reaching $66.50, and is now stabilizing around that level. The gamma squeeze, the frantic algorithmic purchasing, served as the initial spark. But a spark alone does not constitute a conflagration. For a fire to engulf an entire forest, fuel is essential. And within the silver market, the fuel is not comprised of individual investors or renewable energy companies. The fuel originates from commercial short sellers. For 4 decades, the bullion banks have profited immensely from a particular strategy. They offload paper assets when prices are elevated and repurchase them when prices are depressed. They function as a regulatory mechanism, a governor on the engine, maintaining the velocity within established parameters, such as $30 or $50. However, today, that governor failed when the price breached $65. The mathematical implications of their positions shifted from profitable to disastrous. We are encountering reports, unverified but persistent, suggesting that a major American commercial bank commenced liquidating its short position earlier this morning. In the subsequent section, we will meticulously analyze the capitulation of these banks. We will perform the necessary calculations to determine the exact financial extent of the losses incurred by the banking consortium when the price reached $66.50. We will elucidate why a bank's decision to cover its short position represents the most potent bullish indicator in existence, and we will investigate why this specific price point, $65.80, represents a critical threshold of financial distress that could trigger a systemic margin call. The banks are no longer actively opposing us. They are fighting for their very survival. Let us examine the financial figures. To comprehend the current state of panic in New York, one must consult the Commitment of Traders report. This is a weekly disclosure that delineates the long and short positions of market participants. The commercials, a designation for bullion banks, have historically maintained net short positions. This signifies that they have sold more paper silver than they have acquired. According to the most recent data, their aggregate net short position amounts to approximately 80,000 contracts. Each contract represents 5,000 ounces of silver. Performing the calculation, 80,000 multiplied by 5,000 equates to 400 million ounces. This represents 400 million ounces of silver that they are contractually obligated to deliver but do not possess. They engaged in paper sales with the expectation of repurchasing the metal at a lower price, but they sold at $50. They sold at $55. Today, the price stands at $65.80. Every single one of these contracts is currently incurring losses. This constitutes the very definition of a predicament. When one holds a long position, the most adverse outcome is the price depreciating to zero. However, when one holds a short position, the potential for loss is theoretically infinite. Should the price of silver ascend to $100 or $500, the bank is liable for that differential. There is no upper limit to their potential losses. Consequently, at $66.50, the risk management departments within these institutions experienced a rude awakening. They assessed their exposure, observed their depleted inventories, and recognized the presence of a potential liability that could exceed their quarterly earnings. This necessitates a modification in their operational strategy. Typically, when silver prices increase, banks augment their short positions to cap the upward price movement. However, today they are unable to do so. Their credit lines have been fully utilized. Instead of initiating new short positions, they are compelled to close existing ones. And how does one liquidate a short position? By purchasing the asset. They become involuntary buyers, competing with entities like Tesla, with significant investors, and with individual retail participants. At this juncture, the specific price is secondary to their imperative to exit the position. This generates substantial buying pressure beneath the market, acting as a shock absorber for price declines. Every time the price experiences a dip, a financial institution intervenes to cover a portion of their short contracts. This explains the resilience of the $65.80 level. The banks are, in essence, consuming their own liabilities. Let us quantify the financial distress. Market movements are often driven by financial pain, and currently that pain is acutely concentrated within the executive suites of Wall Street. For every single dollar increase in the price of silver, the commercial short position incurs a loss of approximately $400 million. Since the breakout commenced at $60, silver has appreciated by nearly $6. $6 multiplied by $400 million equals $2.4 billion. This represents $2.4 billion in paper losses. However, the situation is more dire, as this calculation assumes they can liquidate their positions at the current price. They cannot. If they were to attempt to repurchase 400 million ounces of silver immediately, the price would not remain at $65. It would skyrocket to $100 instantaneously. This phenomenon is known as slippage. The very act of exiting a trade exacerbates the cost of that trade. Therefore, the actual financial loss is not $2 billion. It could easily be $10 billion or $20 billion. It represents a gaping deficit on their balance sheets. This is precisely why $65 constituted a critical threshold, a Maginot line. Above this valuation, the financial losses become readily apparent to shareholders. Above this level, bank chief executive officers begin receiving inquiries from regulatory bodies regarding their solvency. We are witnessing a gradual unfolding of a financial catastrophe. The banks are attempting to extricate themselves gracefully, striving to cover their short positions discreetly and incrementally without precipitating a drastic price escalation. However, the significant entity we previously discussed is impeding their efforts. This prominent buyer is absorbing the available supply. Consequently, the banks are compelled to bid higher prices. This is the fundamental dynamic of a short squeeze. It is not merely about an upward price movement, but about a transfer of wealth from those entities that suppress the price to those that facilitated its liberation. Every dollar the price appreciates translates to $400 million, shifting from Wall Street to Main Street. How can we ascertain that the banks are indeed capitulating? How can we be certain they are not merely regrouping for another attempt to depress the price? We examine the open interest. Open interest represents the total number of outstanding contracts. In a typical market scenario, when prices rise, open interest also increases. However, during a short squeeze, the price ascends while open interest declines. The reason for this is that short sellers are closing their positions and exiting the market. They are taking their capital and departing. Later today, when the exchange releases the preliminary data for Wednesday, we must closely monitor this figure. If we observe the price at $65.80 and a significant reduction in open interest, it will serve as definitive evidence. It will confirm that the price surge was driven by the liquidation of positions by financial institutions. This is the most bullish signal imaginable. It implies that the persistent sellers have departed. Once the short positions are closed, who remains to sell? No one. The selling pressure dissipates, and the price is then free to ascend to its intrinsic valuation. However, I must issue a warning. Banks, when cornered, can behave erratically. Before their complete capitulation, they might attempt a final, desperate maneuver. They might attempt to offload a substantial volume of paper contracts in the early morning hours to instigate a panic-driven sell-off. Their objective is to ascertain if they can instill fear one last time. Should we observe a sudden decline to $64, do not assume the upward trend has concluded. Interpret it as the death throes of the short seller. Consider it their final attempt to generate liquidity, thereby enabling their exit. Unless the price breaches below $61.50, the prevailing trend remains intact. Capitulation is a process, not a singular occurrence. Consequently, the banks are ensnared in a paper-based predicament. They are incurring billions in losses. They are endeavoring to cover their positions. However, while they engage in these paper-based maneuvers, the physical reality is becoming increasingly constrained. The reason for the price surge to $66.50 was not solely attributable to gamma or short covering. It was driven by desperation, by genuine industrial necessity. In the subsequent segment, we will shift our focus from Wall Street to Main Street. We will examine the divergence between the paper and physical markets. We will analyze reports indicating that major industrial consumers are presently paying upwards of $70 per ounce simply to secure physical metal. And we will investigate the dealer market, where premiums are escalating even as the spot price remains relatively stable. The paper market is in disarray. The physical market is assuming dominance. Do not depart. We must address the $70 enigma. If your sole source of information is the ticker tape displayed on financial news channels, you are overlooking the fundamental narrative. You observe the price at $65.80. You witness the flickering red and green candles and assume that this figure accurately represents the intrinsic value of silver. It does not. It represents the valuation of a paper commitment to deliver silver in New York next month. However, if you disengage from your electronic devices and step into the tangible world, if you pick up the telephone and contact a refiner, if you attempt to purchase a substantial quantity of silver coins, you will enter an entirely different reality. In the subsequent segment, we will expose the significant disparity between the spot price and the transactional price on the ground. While financial institutions are exerting efforts to maintain the paper price below $66, major industrial entities are quietly acquiescing to payments of $70 or more simply to secure delivery. This is the clandestine valuation. It is the price Samsung pays to ensure its manufacturing facilities remain operational. It is the price the United States Mint expends to acquire necessary components, and it is the only valuation that possesses long-term significance. The paper market is a distorted reflection. The physical market is the actual object. And presently, the object is progressing at a significantly faster pace than its reflection. Let us examine the authentic valuation of silver. Why would an industrial enterprise agree to pay $70 when the displayed price is $65.80? The answer lies in reliability. Envision yourself managing a solar panel manufacturing facility. Your assembly line incurs operational costs of $1 million per hour. Should you deplete your supply of silver paste, the production line will halt, resulting in substantial financial losses. You contact your supplier. They inform you, "We can procure silver for you at the prevailing spot price of $65.80, but it will require 3 weeks. Alternatively, you can pay $70 and we will expedite shipment from our emergency reserves today." What is your course of action? You opt to pay the $70. You pay the premium because the cost of the metal is negligible compared to the economic consequences of ceasing production. We are receiving reports of this premium-driven procurement experiencing a surge across the entire supply chain. Manufacturers of electronic components are bypassing the conventional trading platforms entirely. They are engaging directly with mining operations. They are establishing direct relationships with refiners and offering financial incentives to expedite their orders. This is fostering the development of an informal market. Transaction volume is migrating away from the regulated exchanges. It does not register on the standard volume indicators, nor does it immediately impact the spot price. However, it is depleting physical inventory at an alarming rate, even as financial institutions engage in paper transactions to manage their charts. Real silver is being absorbed by industrial consumers at a substantially higher valuation. Eventually, this discrepancy will resolve itself. When the spot market is unable to fulfill its delivery obligations due to insufficient metal, the spot price will inevitably surge to align with the informal valuation. That is when you will witness silver experiencing a significant upward movement within a single trading session. We are currently in the initial stages of this divergence. The displayed price is misleading. The invoice accurately reflects the situation. Now let us examine the retail market, the segment where you and I participate. Visit any major online precious metals dealer presently. Observe the associated premiums. Typically, when the spot price experiences a rapid increase, premiums tend to decrease. Dealers aim to liquidate their inventory. However, today the spot price has risen, and so have the premiums. The reason? Dealers are concerned about their ability to replenish stock. They sold you a coin yesterday at $63. Today, to replace that coin in their inventory, they might be compelled to pay $65. They are experiencing a depletion of capital. Consequently, they are widening the spread. They are charging you $65 plus a $10 premium, effectively setting the asking price at $75. They are actively discouraging purchases unless individuals are experiencing immediate need. Alternatively, they may transition to pre-order arrangements, indicating shipments in 4 weeks. What does this signify? It indicates they do not currently possess the silver. They are accepting your funds today with the hope of acquiring the metal within a month. You are essentially providing them with an interest-free loan. This represents a perilous strategy. If the price escalates to $80 within 2 weeks, the dealer may be unable to fulfill your order. They might refund your $65, stating, "Regrettably, we were unable to source the metal." You will receive your depreciated cash back, but you will have missed the price appreciation. This inventory constraint at the retail level serves as an early warning indicator. When dealers cease sales, it signifies that wholesalers have also ceased sales. And when wholesalers stop selling, it indicates that refiners are no longer releasing product. The entire supply chain is experiencing a bottleneck. Therefore, if you observe $65.80 on the screen, do not assume you can acquire silver at that precise valuation. The entry price for physical ownership is currently effectively $75 or $80. The opportunity for advantageous acquisition has effectively vanished. This brings us to the ultimate risk, a force majeure event. We have discussed industrial buyers willing to pay $70. We have considered dealers charging $80. But what of those holding paper assets, investors in exchange-traded funds, and holders of unallocated accounts? They possess contracts stipulating that silver will be delivered to them. However, a clause present in nearly all such contracts states that if delivery of the metal becomes impossible due to market disruption, the provider reserves the right to settle in cash. We are approaching this trigger point with alarming proximity. If the informal market price is $70, but the spot price remains at $65, the financial institutions would prefer to provide you with $65 in cash rather than procure $70 silver to satisfy your claim. It is financially more advantageous to default. Should a wave of cash settlements commence, it will signify the end of the paper market's viability. It will erode trust. Investors will convert that cash into physical silver, driving premiums even higher. This represents a catastrophic feedback loop for the fiat currency pricing model. Shortages lead to elevated premiums. Elevated premiums result in cash settlements. Cash settlements trigger panic buying of physical assets. Panic buying leads to further increases in premiums. We are currently in the nascent stages of this cycle. The breakout at $65 served as the initial signal. The inability to procure metal at that valuation is the confirmation. If you possess paper assets, you are wagering that the existing system will remain intact. If you hold physical silver, you're betting on the system's eventual breakdown. Observing the current spread, the system is already exhibiting signs of fragmentation. Thus, we have the technical indicators, the financial losses incurred by the banks, the disconnect between paper and physical markets, the mathematical probabilities, the geological realities, and the support of industrial demand. However, one formidable adversary remains: your own psychological fortitude. The forthcoming days will represent a significant test of emotional resilience. Volatility will escalate. News headlines will likely become alarming. The banks will attempt to precipitate sell-offs one final time before the price ascends into triple digits. In the concluding segment of this series, I will equip you with the psychological defenses necessary to navigate this volatility. I will now outline the projected price objectives for the remainder of this week, and provide you with a strategy to ensure you don't divest your valuable asset for a trivial sum. The barriers have fallen, and an expansive landscape lies before us. Be mindful not to falter as you approach the culmination. We have arrived at the concluding segment of this market commentary. We have dissected the mechanisms of the breakout, quantified the substantial financial setbacks experienced by institutions, and revealed the clandestine $70 valuation that the industry is currently grappling with. However, it is now imperative to broaden our perspective. It is exceedingly easy to become engrossed in the micro-level skirmishes. One might easily fixate on $65.80, contemplating its immediate resilience. Yet, by adopting such a narrow focus, one risks overlooking the historical developments unfolding. Today, Wednesday, the 17th of December, 2025, signifies the conclusion of an epoch. The era of inexpensive silver has officially ceased to exist. The period of artificially controlled pricing is over. We have transitioned into an epoch of genuine price discovery. This represents a phase that is simultaneously daunting and invigorating. In the realm of price discovery, established benchmarks are absent. There are no predictable resistance thresholds, as we are currently trading at values unseen for a considerable duration. The market is actively seeking a price point that reconciles a profound physical shortage with a substantial and escalating monetary expansion. I can definitively state that the ultimate valuation will not be $65. It will not be $70. It will be many times our current position. In this final exposition, I will furnish you with the mental fortitude required to navigate the subsequent phase of this progression. I will demonstrate why $65 is, in fact, a modest figure when adjusted for inflation. Furthermore, I will equip you with the definitive strategy to guarantee you retain your prize. Just as the festivities are commencing, the obstacles have dissolved, and an unobstructed path lies ahead. Let us conclude this endeavor. The most significant impediment you currently face is not a major financial institution, but rather vertigo. When an asset's valuation escalates with such velocity, surpassing previous all-time highs and entering uncharted territory, human psychology can become disoriented. You observe your investment portfolio, noting substantial gains, achievements that once took years to materialize, now transpiring within days. Your instinctual response is to question the veracity of these developments, anticipating a reversal and urging immediate liquidation. Financial institutions are acutely aware of this phenomenon and capitalize on it. They understand that individual investors, often characterized as having insufficient conviction, possess what are termed weak hands. Consequently, in the forthcoming days, anticipate heightened market fluctuations. We may witness silver depreciate by $3 within an hour, only to rebound by $5 in the subsequent hour. This volatility is intentionally orchestrated to induce unease, prompting you to divest your holdings out of a desire for tranquility. Do not grant them this satisfaction. Such volatility is the requisite cost for accumulating generational wealth. If you were to liquidate your position now at $65.80, what alternative would you pursue? Would you revert to the dollar, a currency experiencing a 5% annual devaluation? Would you venture into the stock market, currently trading at historically elevated valuations? It is crucial to comprehend that silver's ascent is not occurring in isolation. Concurrently, the dollar is diminishing in value. Silver merely acts as a reflection of the systemic collapse of fiat currency. Refrain from relinquishing your life raft to secure a passage back onto a sinking vessel. Disengage from your screens. Cease monitoring the minute-by-minute fluctuations. Examine the weekly charts. Observe the monthly charts. The prevailing trend is unmistakably upward. The momentum is irresistible. Allow the market to perform its function on your behalf. Some assert that $65 represents an excessive valuation. This sentiment is frequently expressed, stemming from the perception that a valuation of $20 a few years prior renders $65 inherently inflated. Let us examine the historical data. In 1980, the Hunt brothers significantly influenced the price of silver, reaching $50 per ounce. This was the historical apex. However, a dollar in 1980 possessed considerably greater purchasing power than a dollar in 2025. When adjusting that $50 peak for the official Consumer Price Index inflation rate, the equivalent value today approximates $170. Consider this. To merely match the purchasing power of the 1980 high, silver needs to more than triple its current value. At $65, silver is trading at a 60% discount to its inflation-adjusted historical maximum. It stands as the sole asset class globally exhibiting such a degree of undervaluation. Equities are at record highs. Real estate is at record highs. Art is at record highs. Silver, conversely, is still in the process of recovery from a protracted 4-decade bear market. Therefore, when you perceive $65 as exorbitant, remember that you are acquiring the most undervalued asset in human history. We are not at the market's zenith. We have barely begun our ascent from the nada. This perspective serves as your protective shield. When the media projects an image of a bubble, you can calmly reference the inflation calculations and offer a knowing smile. The true bubble resides not in silver, but in the dollar. This brings us to the final query. When should one divest? If the trajectory leads to $100 or $170, at what juncture should one realize profits? The secret of the affluent is this. One never liquidates for cash. Cash is a transient commodity, akin to a melting ice cube. Divestment should solely occur through a strategic exchange. You swap an asset that has become overvalued for an asset that remains undervalued. Presently, silver is undervalued. At some future point, perhaps at $100 or $200, it may indeed become overvalued in relation to other assets. Monitor the gold-to-silver ratio. Currently, approximately 70 ounces of silver are required to acquire 1 ounce of gold. Historically, this ratio has averaged between 40 and 50 to 1. In 1980, it reached a low of 17 to 1. Should this ratio decline to 30 to 1, that will be your signal. You will then exchange your volatile silver holdings for stable gold, effectively doubling your gold reserves at no additional cost and without ever interacting with fiat currency. Alternatively, you may opt to exchange for real estate. In 1980, a median-priced home in America could be purchased for approximately 800 ounces of silver. Today, at $65 per ounce, approximately 6,000 ounces are required for a similar acquisition. Await the convergence of this ratio. When you can exchange a substantial quantity of silver for a down payment on a farm, that represents your exit point. Do not exchange for mere figures on a screen. Exchange for tangible assets like acreage. Exchange for ounces of gold. Exchange for income-generating assets. This is how you solidify the wealth transfer. We have traversed a considerable amount of ground today. We have examined the breakout phenomenon, the gamma squeeze, institutional losses, the disconnect between physical supply and price, and now, the psychological aspects. Wednesday, December 17th, 2025, will be remembered as the pivotal moment. The day financial institutions relinquished their grip. The day the $65 barrier crumbled. The metaphorical genie has emerged from its lamp. The toothpaste cannot be returned to its tube. The global populace is now cognizant of silver's scarcity, aware that its price was artificially suppressed, and is eager to participate. You, however, are already in possession of your seat at the table. You foresaw this development while others remained oblivious. Your sole responsibility now is straightforward. Remain steadfast. Do not divest. Allow the market to fulfill its trajectory. The acceleration has only just commenced. Hold firm. Subscribe.